Hello, and thank you for joining us for our COVID-19 Business Impact webinar. I'm Whitney Roseborough, one of the marketing coordinators here at Squire. We are excited to have you joining us today. Before we begin, I want to point out a couple of things. We have a Q&A section where you can type in any questions you may have throughout the presentation, and at the very end, our presenters will address as many of those as possible. I've also shared a couple of links in the Q&A to some of Squire's business resources. Also, I will be sending out an email to all of the attendees today with a PDF version of today's presentation, as well as the recording of the entire webinar. Now, let me introduce you to our awesome presenters today. First, you will be hearing from Shane Edwards. Shane is an advisory partner at Squire and the Salt Lake office managing partner. He provides CFO and transaction support services to private and public companies. Then we'll hear from Megan Bronson. Megan is a CPA and an advisory partner at Squire. She has over a decade of experience working with businesses across several industries, specializing in QuickBooks consulting and outsourced accounting services for manufacturing and distribution clients. And last but not least, you'll be hearing from Marc Adrus. Marc is a manager in Squire's advisory department. He specializes in providing outsourced CFO and controller services to small to medium-sized businesses across the country, and enjoys helping them develop tools and methodologies to help them achieve success. Take it away, Shane.
Well, thank you everyone for joining us. It's a pleasure to have you here. We have had a lot of new legislation, in addition to new legislation, which I'll be talking about in a moment, or potential new legislation, we've had a lot of rules released by the Treasury and the SBA. So we thought the timing of this webinar was important. Today, as I mentioned, I'll give an overview of some recent discussion of legislation that will likely change many of the principles that we'll be presenting to you today. We'll then give an overview of the recent rules that have been released. Megan will do that. Marc Adrus will then give an overview of the forgiveness application and how that ties into certain tools you can use to calculate the numbers in the forgiveness application. And then we'll spend the majority of our time in just answering your questions. So with that, let's proceed to recent legislation. So a few days ago, the House passed a bill that proposes some significant changes. I should point out that the Senate has a different bill, but the Mitch McConnell, the leader of the Senate, tends to be moving towards adopting the Senate version to match the House version. So what you're seeing on the screen now is the House version, which probably in all likelihood will be the version that ends up being passed and signed by the president. So it has a couple of key points. First, it's going to extend the period of time for which you can use the funds from the 8 weeks to the earlier of 24 weeks or December 31st, 2020. In addition, it's going to decrease the percentage of the funds that have to be used for payroll from 75 to 60%. Further, up until now, you were allowed to defer your payroll taxes until such time that you receive loan forgiveness. And this new legislation would actually allow you to continue to defer your payroll taxes even after you receive loan forgiveness. It's going to extend the rehiring deadline for those that meet the qualifications from June 30th to December 31st. It's also giving some leeway in some of the headcount requirements that are currently out there. Specifically, it addresses this concept of, well, what if you can't rehire the individual, A, or B, you can't replace that individual with someone with similar qualifications. If you can prove either of those facts, you will not be hurt by the headcount reduction. And then in addition to those, if you're just not able to get your business to the same level prior to the impact of COVID-19, which they use as February 15th, 2020, there'll be also some leeway in the forgiveness limitations. And then finally, their plan is to increase the minimum loan maturity from the current 2 years, 2 years after the 8-week period to up to 5 years. So those are all good news for businesses and individuals. And it appears that this additional help is on the way. Megan, I'll turn it over to you to talk about some of the rules that we've recently been introduced to.
Awesome. All right. So we're going to go through just kind of an overview as I go through the PPP loan forgiveness. We're not going to do deep, like look at every little exception or anything through this. We're just going to go through how we are going to go through our loan forgiveness. And as we go through it, it'll include some of the new things that have come about. First off, the period of time where you can spend the forgiveness funds. So we have two definitions here. First is a covered period. That's your 8 weeks or 56 days starting on the loan disbursement date. If you don't know that date, your banker or lender does. So you can find that out. That loan disbursement date is what starts the covered period. For payroll purposes, we have an alternative. This is for convenience only, where you can start on the first day of your first pay period after the loan disbursement date. So for example, if you pay through April 30th is your end of pay period, you receive the funds on April 25th, you have the choice of starting on April 25th, or you can start on the first day of the next pay period, which would be May 1st. This is only applicable for those with bi-weekly or weekly or more often payroll pay periods. If you are semi-monthly or monthly, your only option is the covered period. When you are looking at your payroll costs, you're going to choose that covered period or alternative cover period. But if you do the alternative for one of the payroll costs, you have to do it for all of it. So you can't say, well, I'm going to use my covered period for my bonuses and my alternative payroll covered period for my wages. Like it's all shifted or not from a payroll standpoint. We talk about some of the things that are going on here with the wages. You've got each employee's wage is limited to the annualized 100 grand. So that dollar amount is $15,385. You do not have to do that on a per pay period basis. It's just the total that you pay during your covered period is limited to 15 grand. If you are self-employed, it's tied to your 2019 compensation. For instance, if you are an owner and you pay yourself a wage, you cannot have bumped up your wage in 2020 during this period. You are still limited to your 2019 compensation. There's more guidance we expect on exactly how to calculate that, but if you paid yourself a 60 grand wage in 2019, then you are going to be, if you bumped your wage up to 100 grand because of the new limit in 2020, you're going to still be limited to that 60 grand divided by 52 times 8. If you do not pay yourself a wage, then it's going to be looking at your self-employed earnings or your Schedule C net income based on what kind of filing you do. We're not going to go into those details on this slide, but just so you know, that is something that a lot of owners thought was going to be available, that they could jump to 100 grand, but you are not allowed to do that. for forgiveness purposes. The employer payroll costs, you also, beyond the limits of 15 grand, you can also count all of your employer contributions for health insurance plans, retirement plans, as well as your state and local payroll taxes. This is not income taxes, this is payroll taxes. And if your employees pay into any of these things, so you withhold $150 from your employee for retirement purposes, you need to make sure that the total you contribute to your retirement plan subtracts out their portion. So it's the key here is the employer's portion of those contributions. If you are self-employed, for where you don't pay yourself a wage, you do not get to have health insurance or retirement included in your forgiveness. If you do pay yourself a wage, then you're considered an employee and these would apply. So moving on, our non-payroll costs, this is where we say that alternative period that we talked about earlier only applies to your payroll stuff. For non-payroll costs, it's that 8-week period starting on the day of loan money getting dispersed. So your business mortgage interest, this is loan interest on real or personal property. So this does include car loans, and you're obviously a mortgage if you own a business. You have your business rent or lease payments also on real or personal property. And then your utility payments, electricity, gas, water, transportation, telephone, and internet access. These are the specific utilities that are listed. Out of here, I think it's pretty easy to know what the definitions of everything are. Transportation is something that's everyone's looking for some guidance on, because transportation is a big umbrella. And so we're looking for more guidance on transportation for that. But think of it from a utility standpoint, not a travel standpoint when you're thinking about transportation. Some of the things, no principal payments, no prepayments, and all of these agreements had to exist as of February 15th. So if you just got a new loan, a new line of credit or a new loan or something, those payments are not, the interest on those payments are not going to be forgivable because they had to exist in on February 15th. We have this paid or incurred. So anything you pay during the 8 weeks, and then if you normally pay by the 10th of the month and your 8 weeks is up on like the 29th, you would still have time to pay those bills, and you'd get the 29 days or whatever for that period. You do get to accrue or incur the period of time that even if you haven't paid it out during that 8-week period. But if your 8 weeks ends on the 29th, you don't get the 30th or the 31st. You stop on the 29th. So they would take that month's utility bill and back out a few days. Whatever those statement dates line up will determine the incurred portion. But you don't have to do any special last day of the 8 weeks check run from a payroll standpoint or a non-payroll standpoint. So that's a good thing. We were all worried about that, but this has allowed you to still have an incurred portion. In this example, you could end up having 3 months worth of utility bills landing. So you could be paying for 2 months of it during the 8 weeks, and then incur the end of the 8 weeks into what you pay the next month. And so you could have almost 3 months worth if the date ranges line up right and your cash out lines up right. Keep in mind though that all non-payroll costs are limited to 25% of the total forgiveness. So in order to have anything forgiven from a non-payroll standpoint, you have to have been putting in payroll costs. This was This was designed to get money to the employees and also help you keep paying your monthly expenses. We do have to do a salary reduction analysis here. I'm not going to go through it step by step. I wanted to leave this slide here so that when we email it out to everyone, it will be something that can be usable to people. But you are going to compare your wage rate. So we're talking if you reduce someone's salary or you reduce their hourly wage, that's what analysis is happening in the salary reduction. It's not an hours analysis, it's a wage analysis, like the pay rate analysis that you're doing. I'm not going to go through the exact steps here, but if somebody, and the other thing is this is for people who are working both before and during COVID. So people who were working before and have not come back at all, there's not an analysis that you can do there. So so you do not have to, if somebody is left, you're not going to say, well, their salary was reduced to 0. I guess I'm out of luck. You ignore them. Also, if you pay someone over 100 grand during 2019, you don't have to include them either because they're reducing them down. They're not worried about whether you were paying someone 150 grand and now you're paying them 100 grand. Like they're not worried about that that reduction. So equal or less to than 100 grand during 2019, and people who are on both sides of the date ranges, before COVID and during your 8-week period. Employee headcount, we do have to analyze your full-time equivalents. You are taking the average number of hours paid per week and dividing by 40. You can simplify this. So, sorry, if someone's working over 40 hours, they just get to be 40 hours. You can't account for overtime. You can simplify this. You can say 1 full-time equivalent for someone who is full-time and half for a part-time person. If that simplifies things. If you have people working 20 or less hours, I would say this is probably good. If you have people working in the 30, 35 hour range, I would say you'd want to do a calculation. Weekly full-time equivalents are compared to one of 3 options here. You get to choose whether you want to compare what's happening right now during my 8 weeks compared to a year ago. So February 15th of 19 through June 30th of 19, or do I want to compare to my January and February of 2020? If I'm seasonal, I can choose some kind of 12-week period between May 1st of 19 and September 15th of 19 instead of the Q2 area, basically. We are comparing the full-time equivalents to those 2 things. And so let's say you had 10 employees before full-time equivalent. Now you have 8 full-time equivalent. That's a 20% difference. And so you would take a 20% reduction in your total loan forgiveness. There are some safe harbors here. Let me talk about that. And some exceptions to that is that if you made a good faith written offer, which you have to have documented, to rehire an employee and they rejected it, you have to have that documented and you have to attest that you told unemployment agency that happened. That's something that we were thinking that there was no way to reconcile those things, but you do have to attest that if somebody said no to you, that you within 30 days told unemployment that they rejected an offer of employment. If they're fired for cause, you don't have to consider them as a reduction. If they voluntarily resigned or quit, and then there's some who have, especially with taking care of children and health reasons, voluntarily requested and received a reduction of their hours, you can exclude them from this analysis. So those are some things. There also is a safe harbor. So those are exceptions. The safe harbor is that if you reduced your employees between February and April, and you restored them back to your February 15th employee count or full-time equivalent employee count by June 30th, then you can say, oh, I'm good. So even if for all 8 weeks, let's say the 8 weeks ends June 15th, even during all 8 weeks, you're too low, as long as by the end of, by June 30th, you have hired back your full-time equivalent, then you can get this, this head count will not hurt you. That does have to be proved with payroll, reports, not just well, yeah, I hired someone and then a week later they're gone. So you do have to prove it with payroll reports that they were a full-time equivalent. Lastly, I'll just leave this slide. We do have some documentation. Mainly it's payroll, proving that you actually were paying people through payroll and that you filed those tax returns instead of just saying, oh, never mind. You do have to show that you did make those payments to the people and that went into your payroll tax records. You do need to show that you paid those health insurance and retirement plan payments. You do need to show your full-time equivalent calculations, as well as on the non-payroll documentation. You're gonna the vendors are gonna have to have some statements that are going to prove that you made those payments and what period they applied to. So I'm gonna stop there for documentation. We probably have a lot of questions, and we will we'll let Mark do his application and calculators. He's going to go through some things there, and then we will get to a lot of those questions that still need answered. So Mark.
Thank you, Megan. Hello, everybody. Good to be with you today. I am going to kind of walk through the SBA application for loan forgiveness, the one that currently exists, and then we're going to talk about how you can calculate those numbers and how you can realistically come up with the information that the SBA application is asking for. And going back to Shane's portion of the presentation, a lot of this may change when we get a new bill. I mean, I'm sure it will if we do have a new bill. But for right now, we'll show you what the application looks like. Structurally, it will be about the same with a few exceptions based on the new law. So let me go ahead and share my screen here. All right, so let me first show you here the application, the SBA application. This thing is quite the beast. You can see it's got 11 pages here. It's really great reading. Will keep you super entertained. But I would advise anyone ready to apply for application or for forgiveness or looking to apply to at least give this a skim over, but we're also here to help. This gives some instructions for the PPP loan forgiveness calculations, kind of says what, defining what each of these fields is going to be. And then you can see it just keeps on going here. And what I would recommend when actually filling out the application is that you fill out the top part. You can fill out this information here, and this is the calculation form. And then I would stop when it gets to the forgiveness amount calculation. So the forgiveness amount calculation has quite a few things, as Megan went through and kind of explained the reduction in wages penalty, the full-time equivalent penalty, all of that has to be reported here on the application, but the downside is it's not giving you a format to come up with those calculations yourself. So that's what we're trying to do is present some tools and some guidance on how you can come up with these numbers that the application is wanting. The first thing that I'm going to do here, once you get down to the forgiveness amount application, the easiest way to go through this application is from the bottom up, in my opinion. So I'm going to scroll past some of this stuff that it's looking for, and you can see here, I'm just going to show you really quick. the things it's looking for is just line 1, line 2, line 3. It's kind of like a tax return where it's saying pull this from Schedule A, line 10, add amounts on lines 1, 2, 3, and 4. So it's kind of this whole process, but it's getting this information from other sources, most of it. So let's go down to the bottom here where we're going to put in some payroll data to show you where to fill out these tables to show you or to put on the application what the total amount of wages are. So you can see here it wants employee's name, employee identifier being the last 4 digits of the social security number of the employee, the cash compensation that they earned during the covered period or alternative covered period, as well as the average full-time equivalent here. The last column on here is the salary hourly wage reduction, and you can see it's just they just want you to fill that out. But there's so much that goes into both of these columns here that it's going to be hard for you to fill this out without another tool or using another tool to calculate these things. So this right here, this box up here is for the employees that earned under 100,000 a year. And then the box below it has another section for employees that earn over 100,000 a year. Down here, it actually has a place to report the owner information as well. So let's look up here and say, okay, if I wanted to realistically fill this out, I can come up with the employee's name, employee identifier, cash compensation. You can see this form is only allowing for what, 8 people on here. But you're going to probably need a lot more than that based on the size of your company. I mean, some companies this will work, but some this will be greatly insufficient. So what they expect you to do is calculate this on or come up with another report that would have the same information on it. So I'm going to show you a couple of different tools now. One tool that we'll be looking at is the tool from the AICPA. This they have widely available on their website, and I'll give you that URL, and if somebody else wants to post that in the comments as well. But it's aicpa.org/SBA is where you can find this this spreadsheet under the PPP loan forgiveness calculator. I like this forgiveness calculator. The one downside of it is it doesn't go into huge detail as far as how to calculate the full-time equivalents, and so it doesn't have a payroll by payroll, like you enter payroll number 1, payroll number 2 to come up with this information. It just, if you look over here, it just wants you to list out the employees, and it wants you to list out for Q1 2020 their gross wages paid and their average hours, and then it will calculate the hourly rate. So you can see it starts from a point where you're going to need to come up with some calculations yourself. But if you have these already, this is a good free tool to use, and it's very comprehensive. You can see it's got notes all over the place. It shows you what the purpose is and shows you how to follow the steps to come up with these things. The first thing that it says here is you want to run the payroll report by employee for the full recent quarter, which is this section here. Then the second thing is run payroll reports for your 8-week period. And so it's relying on these payroll reports to be able to generate this information for you. And if we can get the payroll companies, payroll providers on the same track where they can generate a report, then that's going to be great, that you'll just be able to fill out this information. If not, we may have to do it payroll by payroll. But anyway, you can see you fill out this information here and it will do some calculations for you. It will tell you, okay, I use some characters from the office here just as an example, but it also tells you how to get the wage reduction if you have any. You can see that I just did as an example, Dwight was earning $78,000 during Q1 2020, but we dropped him to an average of $52,000 for our covered period, which is below. You can see it does this percent is looking for, is that number 75% or lower? And in this case it was. And so then it says, okay, of the $78,000, 75% of that would have been $58,500. That's your lowest allowable number you could go to. We were at 52, and so it comes up with a $6,500 annual wage reduction, and everything here is annualized. So it's saying, okay, what did you pay? Now, what would that look like on an annualized basis? So the hit that we have to take for an annual, I mean, if we bring that down to the 8-week period pro rata, we took a $1,000 hit on the wage reduction that we gave him. And we had another employee that was hourly that we also reduced. And when it's looking at hourly employees, it wants, as Megan mentioned, it's looking at a reduction in their hourly rate from Q1 to the covered period. And so it's not looking at their hours. That's going to be taken into account in the full-time equivalent penalty. It's not looking at the hours and seeing if you reduce their hours. It's looking at if you reduce their actual effective pay rate. And so this information will then be summarized in this application to pull over to I'm sorry, let me go to Schedule A, where it's saying, okay, this is the amount of let me pull this over. Cash compensation. This is your full-time equivalents. This was the hit you took on wage reduction. And then you can enter the cash compensation for the people that earned over $100,000 and how many full-time equivalents are there. Sorry, I didn't show you that down there. So there's another section down here where you put in everybody that earned over 100,000 or the annual equivalent of $100,000, so $15,000 prorated, $15,385 is what it will cap them at. And so that information all loads into this Schedule A, and this Schedule A is also contained on the application. So it's going line by line. Sorry, let me scroll up here a little bit. It's going line by line on this Schedule A, and the tool here is giving you every line necessary to fill out Schedule A. And so I'm just trying to give you a high-level overview here of what that looks like. It's giving you all the lines that you need, and then it's also telling you, asking you, what was your employer portion of health insurance? What was your employer portion of retirement plans? And what was your state tax amount, local and state tax amount? And you just plug those in there as well. Then it will come up with a total payroll cost. And then it does this calculation where it's looking at your FTEs. And again, this is the same thing that's happening on the SBA application, but because we plugged in this data, it's doing the calculations for us here. It's saying, where were you, like Megan explained, where were you at any of the given periods, whether that be last year, 2019, February 15th through June 30th, or where were you January 1st through February 29th of this year? And then it's saying, let's take the lowest. So we got down, we were at 6.5, and then we got down to, and that's also calculated over here. I'm sorry, I didn't show that, but this is where it does the full-time equivalent input to be able to spit out for you these numbers on the Schedule A. And so we went from 6.5 full-time equivalents down to 6 in our example here, which gives us a 92% full-time equivalent based on those two periods looking at each other. And so the 92% is what is actually is going to give you that 8% ding when it comes over to the actual calculator. You can see here, so we sub to our, one other thing it allows you to do, sorry, let's move over here really quick, is your non-payroll cost tracker. You're going to put in all of your rent, mortgage interest, and utilities, as Megan outlined, to come up with a number that you spent on non-payroll costs as well. And so that feeds into this calculator too, and it says, okay, here's your payroll costs, here's your rent payments, here's your utility payments for a total eligible cost of $69,000 in our example. Then it gives us the ding for the people that we reduced their wages to come up with a new number. And at that point, this new number right here is what gets dinged for the full-time equivalent percentage. So we can only take as forgiveness 92% of this $67,000 in our forgiveness calculation. And so you can see here, these line up very well to what's going on in the application here. Allows you to fill in all these numbers and allows you to take into account the more complex things such as a full-time equivalent reduction or a wage reduction. So the spreadsheet helps you come up with those numbers. We also have internally a Squire spreadsheet that goes a little bit more in depth that allows us to put in our Q1 data. And so you can see here it's showing our payrolls that we paid in Q1 and actually coming up with the hours, the hourly rate, and for anybody that's hourly, and then our regular salary payments. So we can compile all that together. We can do each of the payrolls during the covered period here and do our wage reduction analysis based on that. And so we have this tool that we're using internally to help our clients come up with that data if they would like us to do that for them. Again, otherwise, this PPP forgiveness calculator from the SBA is available, but does not quite go into the same depth in coming up with all of these numbers. So I hope going through these tools and the application, kind of showing you side by side how they relate to each other and how we can come up with the information needed for the application was helpful. I know we're going to have a lot of questions and we'll kind of dig into questions one by one on this, but you can see that the calculations here, some of them are rather complex because they're looking at so many different periods. They want you to come up with full-time equivalents for 1, 2, 3, 4 different periods to compare against each other. And also the wage reduction is a little bit tricky as well. So that's what I have to show you today on the application and the tools that we have. And so we'll turn it back over to Megan and we'll start looking at some of your questions here.
Awesome. Okay. Let's see. Like there's an echo. Sorry. Why? With our questions, we're gonna do a few different categories of questions. I'll still try to pull any more that you send in between answering them, but I think we ought to start with some of our headcount questions. So the first question that we have on headcount says, if I let go of an employee during March and really do not want to rehire them since they were not a good fit for us, how does this affect my loan forgiveness?
So I would
Megan, do you want me to perhaps I can address that question? I'll go ahead and address that question. So from a pure headcount reduction consideration, if that employee was let go for cause, you can exclude them from the headcount reduction calculation, but you need to document that. But if you simply just don't want to rehire them and they were not let go for cause, then it will impact the headcount calculation. There's one thing that I believe people get confused about, and that is you may be okay, you will be okay if you let this person go for cause and you document it for purposes of the headcount reduction calculation. However, if you're not paying that employee, you're not getting loan forgiveness. And therefore, ultimately, it will hurt your opportunities to increase your loan forgiveness if you're not paying that employee or someone that you decide to replace that employee.
Okay. Thanks, Shane. And now another question, do I exclude the owner in my FTE input even though he is a W-2 employee?
Mark, I cut you off last time. You want to take that one?
Yeah, you do include anyone that is a W-2 employee on your FTE. So if he's earning full-time or working full-time 40 hours, you would include him as one FTE, him or her.
Awesome. Okay, on the SBA forgiveness application, table 1, do we fill out the average FTE at the bottom of the table, or do we have to fill out for every single employee? It seems confusing.
So I assume you're talking about on the application here, down here, the average FTE, you are doing it by employee, because they will want to see that in documentation, and you will be looking at that. That will sum up to a total FTE, but they want to see how you got to that total FTE. So you will need to figure out that employee's average FTE over the covered period versus whatever period you're deciding to look back and compare against.
Perhaps this is a good time for me to mention, Megan, as you're organizing the next question, that most of the lenders will be either creating their own customized forgiveness application tool, or there's a lot of software companies out there that are building applications that will match the SBA's forgiveness application. Therefore, you will likely be inputting this information for the application into a bank's either proprietary system or off-the-shelf system. It's very unlikely that most lenders will have you actually fill out let's say a PDF or a paper application of the application itself and having you send that into the bank. It'll all be electronic.
Okay, awesome. Yeah, that's gonna, we still have a lot of time before people figure out how that all is working, because yeah, every lender is going to be different. Hopefully as electronic as possible, as you mentioned, Shane, though. Okay, next let's jump to some of our payroll costs questions. There are some questions that I went ahead and answered in the Q&A for everyone to see. And so just to review a few of the points from there, can we make payments to temporary agencies? Can those be counted? And the answer is no. It has to be actual payroll run for employees. Also, can the 401 administrative fees and the payroll processing company fees be included? And the answer is also no on those. Bonuses, are bonuses included as forgivable? And the answer is yes. However, keep in mind that the limit per person is still the $15,385 for that period. And so you can't go super gung-ho on bonuses, because the wage plus whatever you have left over is really the only eligible bonus you could pay and have it be forgivable.
And Megan, for a period of time, there were a lot of questions in prior seminars about out of ordinary bonuses, as long as it didn't exceed the 15K total amount. But it appears from the SBA guidance that they're okay offering bonuses as long as you don't go over that limit, even if those bonuses are kind of outside of the ordinary process that your company has followed.
And guys, can I bring up kind of another interesting question regarding bonuses? Is what if you paid bonuses during Q1 and you don't plan on paying them during the covered period? Is that going to work against you for the wage reduction?
I don't think we have exact guidance on this, but they keep talking about the salary when they're talking about the wage reduction. They talk about salary and then hourly. And so I believe that it's still tied to your salary, not any commissioner bonus on top of that. But I guess that's up to interpretation right now, because they have not clarified whether your salary is full pay or if your salary is your base salary.
Right. Sorry to throw a curveball at you, Megan, but yeah, I just thought about that. And there's so many questions like that will come up that just we don't have answers on yet. One thing I do want to point out is that the forgiveness, the window to apply for forgiveness is, I believe, 2 months after your window expires. And so there's going to be a lot that happens legislative wise and direction and rules wise in between then, that you don't have to panic about, okay, my loan just, my 8-week window just expired, and now I'm kind of freaking out about how to do this loan forgiveness calculation. You do have a window, a grace period in which you can apply for forgiveness, and I believe a lot of clarification is going to be coming out in that grace period.
Mark, as it relates to that, filing that forgiveness application with your bank, I think it's actually, they have 2 months in which to respond to your application, but to the extent that you delay filing that application for forgiveness with your bank, just be aware that interest will, continue to accrue on that loan.
Awesome. Okay, so then another question that came up was the employer match. Is that even applicable on people who make over 100 grand? And the answer is yes. So the 100 grand annual amount, that brings it down to the 15,385 for the 8-week period. That is limiting just their wages. But the actual employer matches and employer contributions for health insurance, that is in addition to whatever your wage limits are. So that's available for all employees, not for self, like if you're the owner that just takes a distribution, your health insurance and 401k is not included. But employees, it is included. So, okay, so we had a question asking about overtime. So it's asking, with overtime, how is that affecting your payroll costs that are forgivable versus the wage reduction analysis?
Interesting you brought up this question. Megan and I were just talking about this minutes before we started this webinar. And what we determined is that you could have paid an employee overtime in Q1 and then kept them to non-overtime hours in the covered period. But we kind of ran some numbers, and as you're paying time and a half, they would have to work a lot. They would have had to have worked a lot of hours at time and a half in Q1 in order for you to get below that 75% threshold if you keep on paying them the same hourly rate, the normal hourly rate. And so we kind of looked at an employee that worked 20 hours of overtime. You still and did in Q1 in a given week. And then if they did not work that overtime in the covered period, you still would not drop below that 75% threshold, that buffer that they give you, 25% buffer that they give you. So it would have to be you'd either reduce their hourly rate, their regular hourly rate in order for that to have an effect on you. Now that being said, one interesting aspect of that is when it does look at the wage reduction, it's looking at if you do have a wage reduction. So if you did take a person that worked, let's say, an average of 60 hours a week, that was a full-time, hourly person, and they worked 60 hours a week during the Q1, and they only worked 40 hours a week during the covered period. But you did have a 75, let's say you paid them $5 an hour less, and you did have a wage reduction penalty to take for them. You're taking their hourly rate amount reduced and multiplying it by the hours that they worked in Q1. So if they worked a lot of hours in Q1, the penalty is going to be higher for you if you do get them below that 75% threshold. I hope that makes sense. It's kind of complicated
Okay, so yeah, I mean, just to confirm, whatever you pay them during the 8 weeks is eligible for forgiveness, whether it's overtime or normal time. But the wage reduction gets a lot more complicated there, and that you just talked through. I think that answers the question that was asked on that. Next is talking about health insurance. So health insurance is included as a payroll cost, but not part of the wage analysis. We know that already, and it's just the employer's portion of health insurance that matters. So the question is, what all is included in health insurance? Does it include dental premiums, life insurance, workers' comp, etc., or only medical?
I'll take that one. So health insurance, I believe what they're looking at is health and dental could be included. I'm not sure about life because that's hard to stretch that to a medical insurance. So we've kind of just included health insurance premiums for sure. Dental, I think, is questionable, but I think that could be included if you're paying a portion of their dental insurance. You guys can disagree with me.
No, Mark, I would agree. If it were me, I would include both medical and dental insurance. I would exclude the life insurance.
As well as excluding workers' comp.
Correct.
Okay. How about we pay quarterly sales commissions? So we are going to have commissions paid during the 8 weeks, but the commissions are actually related to Q1. Does that hurt us, or can we still count the commissions?
Well, I think there's a lot of gamesmanship that can take place on commissions/payroll side based on the date that you get your loan. The SBA and Treasury, in all of their wisdom, have come up with this kind of modified cash basis method of deducting items. So let's say that you had a commission that was earned in Q1, but you didn't pay it until after you received your funding. And let's assume that you're on a monthly payroll cycle, so you don't have the ability to choose the alternative covered period. So if that Q1 commission, in my opinion, was paid after you received your funding, that would be eligible. That would be go into the pool of expenses that would be eligible for forgiveness. And then on the back end of the 8-week period, you'd be able to accrue for commissions that were earned but not yet paid. So there could be a little bit of double dipping that a person might be able to take advantage of. Mark and Megan, your thoughts?
Yeah, I would agree, because the guidance is saying anything incurred, any payroll costs incurred and any payroll costs paid. So that would fall under the paid category of that. You did pay it then. It didn't necessarily need to be incurred in the 8-week period, but it was paid in the 8-week period.
Yeah, I would agree with what you're saying. I think from a purpose of the funds, I think it makes sense that you should be able to make people right. You know, if you owe them money from back pay or from commissions in a prior period, I think it's an eligible use of the funds to pay them that wage during your period and have it count. There is this disclaimer we're going to throw out there, is that if it's intended to just cover the payroll during the 8 weeks of what you incurred, then the AICPA has some level of disclaimer there that it may result in bringing you down to just the 8 weeks. So payments on stuff for prior periods would not be allowed. But right now the verbiage is allowing for it, and we expect it will continue to allow for it. I'm just throwing that disclaimer out there so that if it comes down to it and they say it's only the 8 weeks, nothing from prior, that you don't come back and say, well, Squire said, you know, but right now the verbiage does allow for both, for paid for during the period as well as incurred at the end of it that's paid on the next pay period.
And I do want to remind everybody about what Shane was talking about. The new legislation, it could make this all a moot point where we have 24 weeks to use that, which would pretty much allow for everybody to use up their portion of the loan, if that happens.
Okay, another question here. If we have done our loan was done during late May, can we apply it to the payroll from April, or does it have to be moving forward? And I guess I'll just quickly answer this, because we just kind of talked about if it was paid after you receive the money, then it's going to fall into the paid category and we think will be allowable. If you had paid the April payroll in May, but then didn't get your funds till the end of May, then it would not be includable because the cash flow doesn't line up. Any comments on that?
No.
Okay. Next question. What about wages that were paid as COVID sick pay or COVID child care pay in through payroll during the 8 weeks? Are those forgivable?
So they are forgivable as long as they weren't reimbursed through the amendment to the FMLA Act, where the company was otherwise reimbursed.
Right. No double dipping, right? That's the message there. What about severance? Somebody who is on severance, who's being removed from severance during the middle of our 8 week period. How do we handle that?
Well, Megan, this is an interesting one because in the application process, the severance pay was included in the definition of a benefit. But when the forgiveness language came out, they moved severance into the definition of salary or payroll and not a benefit. So any severance pay would be subject to the limitation. So I've had several clients, for example, that included severance pay in the benefit side when they applied for the funds. Therefore, they received more monies from the loan, but that person is now still on severance, and they now have to limit those severance pays to the $15,385 over that 8 week period.
Okay.
And additionally, Megan, I wonder if the question has to do with the wage reduction. Does that count towards a wage reduction if we were paying them severance in Q1? Do we have to include them in a Q1 payroll cost to compare against our 8 week period that we're not paying them severance? And I would go back to your W-2s. If it was an amount put on a W-2, I think you have to include it and would have to take the penalty on the wage reduction.
I would agree.
Okay. So some of the non-payroll costs that I want to transition to. What about looking at the nature of lease payments? Like if you're paying a lease on a Porsche, would that be looked at as unreasonable?
As long as it has a business use. And remember, currently it's all of those expenses are only eligible up to 25%. So, but yeah, if your business requires that you have a Porsche, if you're a salesperson and the nature of the business is you need to show up in a Porsche, and that's historically what the company has deducted, then I would say that you'd be eligible for that deduction in the future, or during the covered period, excuse me.
Okay.
I should say, but no advance, no advance payments, as you mentioned, Megan, or you know, you have to play the lease payments pretty straight up based on the lease agreements, whether it's a real estate lease or a personal property lease.
Yeah. With the leases, I mean, there's another question on timing for this, so I'll use it as the example to answer that question as well. But the timing, you cannot prepay for any of those things, but if you are late, or if the covered period allows for you to make a payment during the first few days of the covered period, and then you make your next payment, and then maybe your third payment would be a few days after the end of the covered period, assuming monthly payments. If you would, according to the rules right now, you would be able to accrue for the days of that last payment made, you know, maybe day 60 or something. You'd be able to accrue what you hadn't paid, as long as you still pay it on its regular cycle. That's talking lease payments. That's going to apply to utilities. That's going to apply to your loan payment interest portions. So yeah, the one thing I will say here on the non-payroll side, there is that limitation of 25%. I've been telling my clients as they've asked these questions, I've said, you know, fill it up with the golden stuff, you know, the stuff that is for sure listed, the mortgage payments, or mortgage interest, the lease payments, the utility payments. Just fill up that bucket as much as you can with those things. And then if there's still room, you can throw in some of the more questionable items. Like they mentioned that in the application phase that you could use other loans besides mortgage loans, but then that doesn't seem to be identified at all as a non-payroll cost in the forgiveness side of things. And so it may be that that's considered an acceptable use of funds, but it may not be forgivable. And so we're waiting on them to kind of talk about that more. But it may be that comes down to the lender. If the lender says, yeah, we'll take it, then great. Some lenders are going to say yes to a Porsche lease payment. Others are going to say, I don't think so. But so you're going to have to make sure that that's not your first line item in the non-payroll costs. That if you do, you make sure you get everything else taken care of, then throw in anything that's not specifically supported in the statements. Because some lenders will take it, and you might, if they'll take it, then great. Let that be forgiven. I think we would all hope for that. But that's kind of my attitude on these non-payroll costs. And if the time gets extended, then obviously I think most people will be able to fully be forgiven strictly on payroll, and then the non-payroll costs don't even come into play at all. So I'm going to move us along. I do want to hit some of the self-employed questions real quick, if that's okay. I know we're over time, but let's try to get a few of these done, if that's okay with you, Shane and Mark.
Yes, let's do.
Okay. All right. So as far as compensating owners, so if your owner's on payroll, they're treated like an employee. However, their wage is limited to their 2019 payroll. And so you can't have done an increase. I kind of mentioned that in the slides. If you are taking guaranteed payments, it actually doesn't matter what you pay yourself during the period. What matters is the same numbers you use to calculate your 2019 self-employed amount, which guaranteed payments are included in that, net earnings from self-employment. Your guaranteed payments are already included in that number. Your forgiveness is also still tied to 2019's numbers. It doesn't actually matter what you pay yourself as a self-employed individual during the 8 weeks. They're going to take your 2019 net earnings from self-employment. They're going to take a 0.9235% of that. because of that. That's all you paid self-employment taxes on, and then they're going to divide by 52 times 8, and that's what's automatically forgiven, regardless of your cash flow. A lot of owners have been concerned that they didn't want to necessarily take money out of the business, and you don't have to. You don't have to take money out of the business in order to have it be forgiven. It's still based on 2019. If you are a Schedule C owner, then you're going to take that line 31 on your Schedule C from 2019, divide by 52 times 8. That's what's automatically forgiven. And so you will report that as your forgiveness number on the application. As you'll put that in as the amount forgiven for you. You have your own section. Owner compensated paid to owners is there. Let's see. I'm just reading through to see if there's anything else there. There's a question about whether like the self-employed taxes can be forgiven, and the answer is no. You're getting this automatic forgiveness for the 8 out of 52 weeks, and that is that's all they're going to give you for now. I assume that if they're opening it up to 24 weeks, that anyone self-employed will just have it fully forgiven automatically for their portion. Anything to add? Yeah, go ahead.
I just ask a clarifying question that I've had asked of me.
Yep.
So a person is in let's say a partnership, they file a 1065, or let's say they're a sole proprietor, either one, but they give themselves a W-2, and I think you've mentioned this, but I just want to highlight it. They give themselves a W-2, but they also have money that flows through to Schedule C, and also, if you're a partnership, flows through to Box 14A on their K-1. Is it, I'm assuming it's the combination of the W-2 and the monies that flow to either the Schedule C or the K-1 Box 14A during 2019 that they use as their base for forgiveness during the covered period. Is that correct?
Yeah, that is correct. It still is limited to 100 grand per person. So
that's right.
Even if you have three different businesses and you give yourself a 40 grand wage out of each of those, you are supposed to limit yourself. And one of those businesses would need to have a limitation on its payroll costs that are forgiven. There is a chance that you could get away with it. I mean, I don't know if there's what kind of oversight there's going to be there to catch you in that, but it is the rule. The rule is it's 100 grand per limitation per person. And so you need to consider that if you do a wage and flow through self-employed income. I will say that it's rare that that's going to happen on the same business. You might take a wage from one business, which then makes the rest of your flow through not taxable for self-employment purposes. And so it would just be the wage in that one business, while another business you may be all self-employed earnings with no wages. And so so it shouldn't happen too often that you're trying to pull a bunch of things together. But I do know, we have several clients who own tons of different businesses and take wages from multiple. So anyway, does that answer your question?
Yeah, and then Megan, another clarifying point is on when in this whole, whether I'm a partner in a partnership or a sole proprietor or an owner of an S Corp, when can I or when can I not take forgiveness for benefits? There seems to be some confusion still in that arena.
Yeah, so for benefits, if you are an employee, then you are part of the group's insurance plan and benefits plan. So you would, your wage would be limited your W-2 wage will be limited, but the benefits and 401k match from the company's level would be able to be included if you are an employee. If you are not an employee, and so therefore you are just having the business pay your insurance as an owner, then you do not get to include those things. So that's what they have. That's how they have it. Is if you're an employee, it can be added in. If you are not an employee, you do not get to count those things separately.
Thank you.
Okay. Lastly, just a few extra little questions. With the legislation, the 15K, if they extend the weeks, would the 15,385 also get extended to be higher to account for it? I would say yes. Any thoughts there?
I would agree.
Yeah, that 15K is literally just divide by 52 times 8. So if they make it 24 weeks, they divide by 52 times 24. Like, that's how I think they will limit it. Depending on whatever week they land on, it will get limited at that week range.
Keep it in mind, in no case can you get more than 100% forgiveness of your loan.
Correct.
Plus interest, yeah.
Correct. What about the idle money received? Does the advance idle money received come out of the PPP loans received? In other words, my understanding is that advance money never had to be paid back.
I can take that one. I'll show you on the application. Well, I'll show you on the tool that we have. It does have a area here for the emergency grant. So you can see here the forgiveness amount would have been 62. If you had a $10,000 grant given, that just reduces the amount of forgiveness because they're including that 10,000. They're saying keep that 10,000, but now only 52 of your 62 is forgivable. So it just reduces the amount of forgiveness.
Right. Well, and just so people are clear, the 10 grand is in addition to all the PPP funds you received. And so, so when you did, depending on the timing of when you submitted your PPP application, the 10 grand increased what you got. And so all they're doing is taking it back out. Like, you might have gotten a 100 grand loan, but 10 of it was really the idle amount. So when we take the 100 grand loan, you only can have 90 of it forgiven because 10 of it was really the grant in the first place. Like, you would have only gotten 90 without it. Does that make sense what I'm trying to say there, Mark?
Yep.
Okay.
I think that answers the question.
It should wash is what I'm saying. You know, it should be a wash.
The money they gave you from the idle grant rolls into the PPP loan amount is what it's doing.
Yeah. And then that can't, that would not be forgiven because it was given in addition. Like the 90 grands, I don't know exactly how it works, I guess. I can't say it right.
Yep.
But, okay, next question is, we have not been approved for an idle loan yet, but if we end up getting approved before we turn in the forgiveness application, how does that affect our loan? And I want to say the idle loan doesn't have anything to do with the effect on the PPP loan. It's just that grant, that 10 grand, that is a factor. Would you agree?
Yeah, they should push you out an amount to begin with that had you not received a PPP loan would have been a grant, right? But if you got a PPP loan, that grant amount rolls into the PPP amount. So instead of a $75,000 loan in this case, it's kind of viewed as we got $85,000. So now our forgiveness amount is a little bit lower. We owe a little bit more back because we weren't able to use it all.
And Mark, I think they may be talking about the loan portion, not the grant portion.
The loan portion is completely separate. Yep, the loan portion has nothing to do with the PPP, but the grant portion does.
Yeah, assuming that the EIDL loan portion came after you received your PPP loan. Otherwise, there's a different outcome. But those that are receiving EIDL loans, not grants, but loans, after the PPP loan has been issued, it should not be an issue.
Okay. Now, will the forgiven amount have a 1099 issued for it? We do not know the answer to that one yet. There's still, right now, the loan forgiveness is not taxable, but at the same time, your expenses are also not deductible. And so we are not sure, like, because it's non-taxable, we don't think there will be a 1099 for the forgiveness, but the legislation is trying to make that still deductible, the expenses still deductible, but that's still up in the air right now.
Yeah, so just to be clear, the amount of forgiveness will not have a 1099 ramification because it's not considered taxable income. But as Megan mentioned, there's significant pressure on our legislators to allow the expenses we incur during the covered period to be deductible. But we will have to wait and see. That's not in the current set of legislation that's being presented to the Senate.
Correct. So the next question, I am a greater than the $2 million loan. Can I schedule an audit now so we can get over shortly after forgiveness, or rather than just being, you know, a few years down the road and they finally want to audit me?
Well, you can't apply for forgiveness. It's my understanding you can't apply. You cannot send in your forgiveness application to your bank. And I'm assuming this is a PPP loan, not an IDA loan, but assuming if they're talking about a PPP loan, you cannot submit your forgiveness application to the bank until the covered period is over, and that covered period is currently 8 weeks. But then once you submit it, as I mentioned earlier, the bank is required under the statute to get back with you, to get a decision back to you within 2 months. I think the legislation is 60 days. But then the SBA, if you're over 2 million, the SBA then extends that period over which they then have time to further audit you. And I forget the exact extension beyond the 60 days, but it's Mark or Megan, if you know off the top of your head, but let's say it's another month or 2.
Yeah, I don't know.
Yeah. So those with over $2 million loans, yeah, the SBA is extending the period from which they can come in and audit you independent from the bank.
Yeah, I think we don't have any control over that. So I don't think we can even say, yeah, please pick me first. I don't think we can. It'll just be their algorithm that puts you in the line somehow.
Yeah. And there's literally thousands and thousands of people that got loans over $2 million. It's not feasible with the SBA staff to audit every single one of them. So.
Right. True. Okay. A few other questions that have come in that I wanted to cover. If we made a layoff in January, does that count against our FTEs? It probably, they're saying it didn't really affect their payroll numbers until February because of the last pay period to pay them.
It depends on the period you're going to look back against for your FTE calculation. If you're looking at the 2019 period of February 15th to June 30th, 2019, then that will affect your FTE because that person's not in there anymore. However, if you choose the January 1st to February 29th period, you're probably going to be okay there because for most of that time, depending on what time in January, for most of that time they were not considered an FTE, so your amount will be lower. What I would just suggest is calculate your average FTEs for all the periods that it's looking at. Those, if you're seasonal, there's 3 periods it's looking at there, but if it's just the 2019 or the beginning of 2020, figure out which number of those is lower and use that number.
Yeah, so the two periods to which Mark is referring is February 15th, 2019 through June 30th, 2019, or January 1st, 2020 through February 29th, 2020. Choose the lowest of those two numbers. Those two dates.
Yeah, so you may have incurred a loss for him or her in the 2019 one, but average overall you may have had lower FTEs in that 2019 period versus the 2020 period. And so just use whatever is lower based on all of the employees together.
Awesome. Two more questions. One is access to the spreadsheet. I just want to let everyone know I did put the AICPA's calculator link into the Q&A announcements, and so you should be able to find that link there to use theirs. If you'd like to use work with Squire, we are more than happy to help anyone with their calculations and using our tools to provide a really great packet that you can work with your lender on. But it is not something we are providing out there, mainly because of the complexity of the spreadsheet and the training that has to go into understanding what all is going on with it. And
Um,
And the legislation changes that may happen.
Right.
Yeah.
Right.
Yeah, the AICPA spreadsheet has less capabilities, less bells and whistles. Therefore, it's a little easier to operate if you're not trained. The Squire version has, again, more bells and whistles, which required more programming, which makes it easier to mess up if you don't have proper training.
Mark, is there a password to use for the AICPA spreadsheet?
No, their spreadsheet is open to use, but they've protected a lot of the cells with the password, the ones that you aren't supposed to get in and fiddle with. And so they're not giving out that password, obviously, but everything in blue on their spreadsheet is meant for you to put a number in, and you shouldn't have to touch any other cells besides those.
Okay. And then the last question so far is, how long should we be keeping the documentation to support all this for future potential audits?
I would say through the latest period that the SBA has the authority to audit you.
Actually, there is guidance specifically on there. On page 11 of the forgiveness application, it says the borrower must retain all documentation in its files for 6 years after the date of the loan is forgiven or repaid in full. And you have to let people have access to those files upon request.
Interesting.
Yeah, so that is
So-
specific there.
Yeah. It'll be interesting to see how that ties into this concept. Does that mean that the SBA can come in at any time and, 4 years down the road, disagree with a decision that was made on forgiveness? That's not how I read the legislation, but let us hope they don't go there. That would be almost impossible to manage.
Yeah, that seems pretty extreme, but it also, I think, gives them more time to get through their backlog. Maybe, I don't know. But yeah, don't get forgiven and then be like, great, I'm out of here. Make sure you hold on to that stuff so that you're set if anyone asks later. All right, well, that is all the questions we have. I think we can call it a good day.
I think we've sufficiently bored everybody.
Thanks for joining, everyone.
Thank you.
Thanks.